Let's take a look at the credit markets now. In fact, investors, well, I guess our knowledge of credit markets certainly has increased over recent weeks, given what's transpired in the banking sector, with the bondholders particularly suffering, as we saw in terms of Credit Suisse. So what about private credit? Well, let's get into that, the opportunities seen in that space at the moment. Mark Sherwood joining us from iPartners. Mark, very good to catch up with you again. Thanks for joining us again on Ausbiz. So, of course, it's all about tighter credit conditions at the moment in the wake of the banking crisis. So what trends are we seeing develop as far as private credit is concerned?
Yeah, private credit has grown enormously, Andrew, and that's just nothing just in the last short term, but particularly even over the last 5 to 10 years. I think the statistics say that globally, private credit has grown by about tenfold over the last decade. So it really speaks to how big a role private credit is playing in general credit markets. And when we talk about private credit, really what we're talking about here is lending to private businesses, and particularly that the banks are not taking up. So the marketplace is enormous, and it obviously closely correlates what's happening in public markets though. So when we've seen the volatility that we've seen in the public markets in the last week or two, particularly if credit spreads generally widen in a risk-off environment, that does flow through to the private markets as well. So we've seen a little bit of push widening in yields, and that also gives a little bit more choice to the investor as to what they want to look at and what they're willing to receive to take on a particular credit risk.
Yeah, so we've obviously seen, well, certainly since the global financial crisis, that evolution of private credit. But what happens in that space when markets are volatile?
Yeah, when markets are volatile, investors do step back a little bit. We saw that probably a little bit when in the last sort of week or so, when the sort of global banking mini crisis hit the markets, where there was a little bit of nervousness coming through in private credit markets as well. I think that it just shifts the bias a little bit towards the investors' hands as opposed to the borrowers' hands. The borrowers almost have to become a little bit of price takers in a generally bearish market environment. There is still very good quality businesses out there, businesses with sound and stable cash flows that are looking to borrow from the private markets, but they probably lose a little bit of power when markets are generally in a bearish state. So it probably just swings the bias a little bit towards the investor's hands. It gives the investor a little bit more negotiation, the holder of the capital that's in demand, and it probably just makes the cost of capital just start to swing higher for those private companies.
So yeah, in times like this where we see those building economic headwinds, is a case where private credit funds pull back on, excuse me, their position in terms of the size of those debt facilities.
Yeah, size has probably come down a little bit. People require stronger covenants in their documentation. If we're talking, asset-backed and real estate transactions, people tend to tighten up their threshold or their comfort zone around loan-to-valuation ratios. So all these different dynamics that go into any lending deal feed straight across to the private markets as well. So people can afford to be a little bit more choosy in what they're willing to put their capital into, and then they can often negotiate slightly stronger terms in terms of covenants and lower LVRs and these kind of metrics in a particular deal, and we've been doing that ourselves.
Which particular sectors are we seeing growth at the moment in private credit deals?
The non-bank lending sector in Australia is very active, and it has been active for the last 12, 18 months. We've got a couple of things on the go right now for non-bank lenders. We're not talking necessarily about buy now, pay later, but true credit organisations with extensive credit licences that do extensive credit work on their borrowers. These types of organisations are of real interest to both us and to the investor. And they rely on the private credit markets to get the capital that they need to continue to grow their business in a sound and measured way, which we've seen in the sector. So definitely the sort of non-bank lenders really are utilising the private credit markets in Australia.
What's happening in the real estate space at the moment, Mark? Obviously, well, we know what's happened to those prices, but has that actually has that encouraged more deals to be done?
I think there's definitely a lag in prices, and I think vendors generally in real estate are a little bit reluctant to move towards where the reality is. So I think we're still in this period of lag between weakness in prices, giving the buyer a little bit more choice and opportunity, but then vendors coming down to meet those prices. I think it's going to continue this way. There's no doubt that vendors will get a little bit more realistic, and there'll probably be some really interesting buying opportunities across the range of real estate sectors. For us, we're definitely seeing some interesting deals, both on the equity side as well as the debt funding side. We're active in a debt funding deal in the institutional market right now, which is a very large CBD office construction type of asset. So there's some really interesting opportunities out there for the investor, and the strength there is that there's no hurry. You can afford to be selective. Vendors will get a little bit more realistic, I think, in the next couple of months in Australia particularly, and that will create some new opportunities for the investor.
I was looking at recently at some of the news in the real estate sector, and pointing to there have been a lot of pub acquisitions lately. I've gathered that you're also involved in that space as well.
Yeah, we've been involved in that space for a few years, Andrew, and we're actually raising doing a further capital raising for a pub acquisition in suburban Adelaide. So there's some unique opportunities to buy freehold land pub opportunities in Adelaide, where you've got very strong operating earnings from the operations of the pub, and then obviously you've got some potential growth in the land, and particularly if you can buy an asset where you can utilise the space of the land a bit more effectively. So that's really our focus there. We like the suburban pub style asset, particularly if you can buy at very decent prices, i.e. Reasonable cap rates. Quite different, I guess, to the dynamics of trying to buy a kind of pub accommodation hospitality asset in a major city where prices are always very, very competitive. If you can look at some of the regional towns, you can find that there's some unique buying opportunities if you're on the ground and selective. So yeah, that's quite an active space for us, and we like both the freehold ownership of the property and the land, as well as the earnings that can come from the operating entity.
And Mark, given interest rates remain so dynamic at the moment, what needs to be considered, particularly if you're focusing on where you're making that comparison between fixed and variable?
Yeah, the fixed variable component, I would say there was a massive shift in private credit, particularly in terms of investor demand across to floating. Maybe a year ago when everyone was starting to expect all the rate rises. Now that we've had such incredible amounts of rate increases, and obviously you've got a market that's pretty actively talking about the risks or the necessity perhaps later this year of potential rate cuts, we're now seeing a real shift. So investors now are probably more interested in looking at transactions on a fixed rate basis, where they know that they can lock in a certain level of return, perhaps for the next 2 or 3 years, if it's a 2 or 3 year termed deal, and kind of decrease the risk that they're going to make lower earnings on their money in the next couple of years if rates indeed do start cutting at the end of this year or through next year. So there's been sort of two swings. We saw a strong swing towards a preference of floating rate deals and floating rate returns. Now, definitely, people are very conscious of the chances that rates will be cut if we're forced into a recessionary type environment, and people are very happy to lock in some decent returns for a couple of years.